Today we're going to discuss some ICT concepts that are very crucial for first-time traders and also advanced traders to understand what is happening in the markets. So today our discussion is going to be focusing on some key areas, like now the mitigation blocks, fair value gaps, order blocks, weekly ranges, the quarterly theory, and then finishing off with the kill zones. Let's now get started. Starting with the fair value gaps, basically it is an imbalance or an inefficiency in price. It occurs when a single candle moves so fast that the wicks of the candles before and after it do not touch each other. As you can see here, this candle moves so fast, leaving this gap behind, where only one side of the market was offered. Like now you can see over here, it offered the buy side and also leaving the sell side not covered, as seen also in that side over here. Moving on to the order blocks, basically an order block is more than just a last candle before a move. It's a specific area where where the banks or the institutions players placed heavy orders, causing a change in the state of delivery. Like now, an example, you have the bullish order block. This is the last down candle or a consecutive candles before a sharp move upwards that breaks market structure. As you can see over here, we see that this large dark candle over here is an order block, which took the previous liquidity and then pushing price bullish. The validation is that it must be fast, it must be energetic, and leaves a fair value gap behind. Let's now move on to a breaker and the mitigation blocks. A breaker block basically is a failed SMT, smart money tool. It occurs when price makes a higher high, grabbing liquidity, and then aggressively breaking below the previous higher low. The pattern is basically the low, which goes to a high, and then goes to a higher high. The break of the market structure occurs thereafter. When the price returns to that previous high low, it acts as a breaker entry. Well, these two can look similar, but the difference lies in whether a stop hand happened. The mitigation block, on that hand, mitigation block is basically a breaker without a liquidity grab. It happens when price fails to make a higher high or a lower low. It then breaks structure. The pattern is low, leading to a high, leading to a higher high, and then that's a failure swing, and then break off the market structure. We use this to mitigate or exit their losing positions at a break even. This is where the banks exit their positions. Let's now continue on to the weekly ranges. This can be very daunting to the new time traders because they do not understand what happens in the weekly ranges. Let's now begin by the explanation. The ICT teaches basically that the weekly range or the weekly candle isn't random. It follows a power of three, which is basically accumulation, manipulation, and then finishing off with the distribution. The classic bullish week opens on Sunday or Monday, drops below the opening price to trap sellers, which is called the manipulation, usually creates the low of the week on Tuesday or Wednesday, and then rallies towards the Friday close. Key pro tip: if the low of the week isn't formed by Wednesday, New York session, be careful. The profile might be sick and destroy, as can be seen during the NFP weeks. All right, now let's go to the quarterly theory. The quarterly theory, this is the timing element of the algorithm. It suggests that the price moves in circles of 4, so the quarters. This applies to timeframes ranging from the yearly chart down to 90-minute cycles within a day. The 90-minute cycle every single day is broken into 90-minute segments, e.g. at 12 to 1:30, 1:30 to 3 a.m. in the morning. The phases are as follows. The first quarter is always accumulation, price stays in range. The second quarter is manipulation, price breaks the range to hand stops, called the Judah swing. The third quarter is the distribution, the real move of the session. And then we have the fourth quarter, which is known as the reversal or the continuation. Price either finishes the move or pulls back. Now let's discuss the kill zones, which is the last topic of today. The 4 primary ICT kill zones Remember, all the times are in New York local time. First Killzone we want to start with is the Asian session, which actually happens from 7 p.m. to 10 p.m. in the evening, New York time. The purpose of this is accumulation. The role of this session typically creates a tight range. It engineers liquidity by leaving buy stops above and sell stops below the range. Trading tip: most ICT traders don't trade this session. They use the Asian range as a reference point to see which side gets hunted during London session. Let's now go to the London skill zone, which is now ranging from 2 a.m. in the morning to 5 a.m. Purpose of this is manipulation, also called the Judah swing. This is often the most important session. It frequently creates the low of the day in a bullish day or the high of the day in a bearish day. Price will often rally above or drop below the Asian range to trap retail traders before reversing and trending for the rest of the day. Let's now go to the New York kill zone, which is now from 7 a.m. in the morning to 10 a.m. Purpose of this is distribution or continuation. This session usually sees the most volume. If London has already set the low of the day, the New York will often provide a retracement into the fair value gaps or the order block for a continuation move, which occurred during the London session. The key event, let's say there's news during the 8:30 a.m. in the morning, like now you can have high impact news of the CPI, NFP, which can act as a catalyst of the move. And then lastly, we have the London close kill zone, which occurs between 10 a.m. in the morning to 12 p.m. This is the reversal or profit-taking session or time period. As London banks close their doors or their books of the day, price often sees a retracement or a dead cat bounce. Strategy for this trading this kill zone is to look for a sweep of the morning's high or low, followed by a quick scalp back towards the middle of the daily range. Now let's see how you can connect these concepts of the kill zones. To be successful in ICT, you must combine these tools into a single narrative. Time of the day must be very crucial. You must ask yourself, is it a kill zone? E.g., now we have 8:45 a.m. in the morning during the New York time. We have liquidity. Did price just sweep the Asian high or a previous daily high? Market structure shift. Did price break a single low, struck high after that sweep? If yes, then continue. In the entry, you must ask yourself, is there a fair value gap, order block left behind after that break? The midnight open, we have the ICT emphasizes at 12 a.m. in New York open price. In a bullish day, you want to buy below the midnight open. You must buy at the discount. In a bearish day, you must buy at the premium. It must be above the midnight opening range. So thank you guys for watching. We'll see you next time as we discuss some other aspects of ICT trading strategy. Thank you so much.